This is the Note Closer Show, where you get the latest developments in distressed note investing and learn the secrets of how you can control millions of dollars worth of property for pennies on the dollar. Get educated and entertained by someone who has closed thousands of deals and lives to support you in achieving the same. Now, here's your host, CEO of We Close Notes, Scott Carson.
Good morning, good afternoon, good evening, everybody. Hope you're doing well today. Welcome to this episode of the Note Closer Show. It is a nice and cool, crisp day. Everybody's looking at me funky because I'm wearing shorts in the office, but it is actually feeling a little bit like October now. It feels like camping weather, doesn't it? It feels like I should throw a good pot of chili on and some good cornbread this morning and just kind of chill out at the house. But today is today's Tuesday. It is a wonderful day, getting rocking and rolling. I'm running a little bit slow motion, waiting for the coffee to kick in, but that's all right. I had a great time last night on our Note Night in America as we did a quick preview video of what's all going into Note Camp, all the little different things that people have available to them to network with other note investors, how to access the content, how to use the virtual manual that Nicole's worked so hard to put together. Nicole, you've got a video up in Basecamp as well for those that are part of it.
Yeah, I put it up probably 15 minutes ago.
Yeah, and so we're excited. Now it's a matter of getting the links out to all the speakers and dealing with that cat herd of tech checks and things like that. But today's topic, it kind of comes back from what somebody asked last Thursday when I posted something on Facebook about a topic I should have for Friday. And I have to thank people for posting what they'd like to hear, because I use it not just for one day. It allows for me when I go throughout the week to come up with episode ideas for you all. And with us being kind of a shorter week here before we kick off Note Camp 4.0 this Thursday at 12 noon, yeah, we've got a lot of things going on. Just got a phone call from an investment club that wants me to ship some swag bag stuff out, some goodies out, which we'll get working on in the next week or two. But today's topic is something that a lot of investors ask me about. A lot of new people ask me, a lot of people that come from the corporate world that have retirement accounts or have some money saved, they ask me out because they're a little concerned about having the money questions with potential funding partners. And so today's show is all about, what do you ask? How does those conversations go? You know, what is anything that we should do to do our own due diligence on our funding partners? And so I thought I'd start with a very basic aspect of things. As you're out networking, as you're out talking to people, you've all heard me talk about the fact that it's good to have some like deal samples. It's good to have something tangible for your potential funding partners or people you're networking with to take a look at. Having something on a piece of paper, a photo of the property, having the deals in hand helps tremendously when you're having that conversation, because it gets something that you can look back to versus just talking theory. And I think a lot of people miss the boat when it comes to that facet of the business. Is it's not about the money, it's more about the deals. And you have to make the focus of your conversation, on the deals you're working on, the deals that you close, or the deals that you're going through due diligence on. Having something tangible is much better than not having something at all. Case in, and also good deals find money. It's not the other case around. You shouldn't be running out raising capital until you make an offer on a deal, because you're never going to have something tangible, and investors want to look at something tangible. They want to get something you're actually working on, or a case study, versus something, this is what we kind of do. Does that make sense? So I know we're going to have plenty of questions today, which is quite all right. That's what we're here for. So very simple. One of the biggest, easiest ways I'm a big believer in doing is you got to build rapport first. Okay. I mean, going up and asking someone if they've got money to invest right off the bat is kind of like in going and asking the girl at the bar if she wants to go home with you, or guy, if you're a lady, hey, you want to go home? You don't do that. You have to build rapport. You have to have a conversation. You have to get to know that person a little bit. And sometimes it takes time. Good relationships are built over time. It's like dating. Now, maybe some of you went home with your spouse on the first date and it worked fine. But for many of you, it's a process of dating. It's a process of getting to know that individual. It's a process of building that rapport and getting to like and trust on both sides of the relationship. It's not just one side, it's both sides. And there are times I've had people come to me that were ready to fund a deal, and I won't do their deal. I won't let them fund a deal because I just don't like them. I I like them as an individual, don't get me wrong. They're fine, but I just don't like their business activities. And I'm fine having a conversation with them, friends with them, but I think they would just be a nightmare when it comes to being a funding partner. And I'll share a little bit of how we decipher that as we get rocking and rolling through some stuff. So it's all about, if you need help with ice breaking, with talking to people, you can use the FORM method. And you just think of FORM, F-O-R-M. All right. And some people, well, they do from, but that's okay. FORM or from it starts out with F, is where are you from? Very simple. Hey, where are you from? Okay. My ex-father-in-law loved to do that. We'd be sitting out, if we go tubing or something, he just asked regular strangers going by for 2 Bud Lights. Hey, where y'all from? Where y'all from? Where y'all from? And that just voice sticks in my head. But anyway, where are you from? The second thing is what do you do? What do you do? What kind of investing are you doing? Or that's if especially a real estate club or a networking event. What are you in real estate? What do you do in real estate? Are you a realtor, mortgage broker, investor? So O of FORM is the occupation. What do you do? Third thing, the R aspect of that. The R aspect of that is recreation. What did you do for fun this weekend? Did you watch the game? Did you go somewhere? Did you go to the festival? Did you go to an event? What did you do for fun? Okay. Now, the key thing is if you ask those 3 questions and they don't come back and ask you the same things, they're kind of rude. All right. Now, the last big thing is M is your message. And you want your message to be short and kind of sweet. You don't want to throw up on them, have diarrhea of the mouth, just bleh, on them, and they're like this, and they're looking for somebody to, oh, hey, I got to go. Okay. You don't want that. You want your message to be relatively short and sweet. One of the best messages I've ever heard was when Stephen Lloyd talked about this. I don't remember what it was. I think it was a Stretch Mortgage Expo in New Jersey back in February. He talked about I raise capital. When people ask me, I raise capital for real estate projects. Okay. That's pretty cool. And then ask more, oh, tell me more about that. It's a leading kind of response to get people to dive into, well, I buy distressed notes. I'm a mortgage investor. We buy distressed mortgages from banks and hedge funds, and then we work to try to keep the borrowers in the houses if we possibly can. Whatever your little 10-second, 10-word, whatever it is, message about what you do, it's got to be clear and concise, and it's got to be focused. One of the biggest things that always drives me bonkers is when somebody hands me a business card and I'm meeting with them at the first time, and I flip it over and there's 12 things. You ever see those? There's 12 things. I'm a notary. I'm a realtor. I'm a mortgage broker. I'm also a legal aid.
It looks bad.
It does look bad, doesn't it? It looks like you don't know what the hell you're doing. It doesn't mean that you trust me. You don't want the guy doing your oil on your car to do your taxes and mow your lawn or be your interior designer. You want somebody who's focused, who's an expert at what they do. And yes, I get that. Unfortunately, a lot of people have gone to real estate seminars and workshops, and they've been sold the bag of goodies. Oh, here's how you market. Here's that, all that stuff. And, I have tools. Whatever type of deal comes my way, I can do the deal because I've got the tool to fix it. Well, if I have a plumbing issue, I call a plumber. If I've got a pest issue, I call a pest. Okay. If I need my lawn mowed, I'm calling a lawnmower. All right. I'm not calling somebody that is too generic in nature. Now, yes, they might do a cheaper job, but you often get what you pay for. That's the thing you got to keep in mind. If somebody's doing a multitude of different things, they're not an expert at any one of those. And they're probably looking for deals, and they're going to be all over the place. Okay. So don't be that individual, because an investor is going to look at that and think, well, you're all over the place. Give me a phone call if you get a deal, but they're not going to look at you right. Well, versus, this is what I do. This is the one type of thing I do. I want to be known so that when they have a deal in Austin or they know me as the note guy, that's what I focus on. All right. And honestly, the whole idea of the note guy came originally from me just doing videos years ago. And then I actually went to 4 different real estate investment clubs as I was traveling the country in a week period. And people, hey, you're that note guy who does the videos. You're the note guy. They get to know me as the note guy. It wasn't the fix and flip guy. It wasn't the wholesale guy. It wasn't the substitute guy. I was the note guy. And that stuck. I was like, I got it. Boom. Hit that nail on the head. We'll keep that shut. All right. So as you're communicating in your network, as you're talking to your tribe, everybody's got a tribe. Okay. Everybody has a group of people that are around them that they network with, that they're in their geography, their hemisphere, you're going to communicate with those people, whether they're friends, families, people you meet, going to network clubs, stuff like that. You want people to start to recognize you as that person, not the guy with a stinky bad BO or the jack of all trades, but somebody who's consistent in what they do. And sometimes it can take time, especially if you're just going once a month to a RIA club. It could take you 4 or 5, 6 months to get to one of those, to build enough consistency to show up. Now, if you're out networking in other areas and the people are connecting, it won't take as long, but it's still about getting the word about what you're doing. Now, what does this have to do with funding? Well, if you do this on a consistent basis, like many of you guys are that are successfully raising money, you're going to have people that come to you. And I make sure when somebody comes to do, they talk to me, hey, we'd like to talk about funding some deals with you. Okay, great. That's a much easier conversation to talk about them wanting to fund my deals versus me, oh, let me pitch you on a deal. Don't get me wrong, I still don't mind sharing what the deal is and making sure that the deal makes sense for people. You want to make sure the deal makes sense, okay? But it's all about the investor questionnaire at that point. So when it comes to you and says they want to do deals with you, they want to fund your deals, one of the first things that we ask them to do is, okay, great, awesome. How much are you looking to invest? What number are we talking about? Because you want to find that number out relatively quickly, because the last thing you want to do is spend an hour talking with somebody about a deal and they only got $5,000 or $10,000. Okay. And I'm not bashing anybody who's got to start off with $5,000 or $10,000, but those people need to think more so about raising capital themselves. Instead of funding a deal, they need to look at doing some marketing themselves and either going and finding deals or growing that nest egg. Okay. Because you can't really do much with anything below $20,000 for the most part. I mean, you can. It's not the most effective way. A lot of times when you're using somebody's last $5,000 or $10,000, there are going to be a lot of problems, headaches, reaching out to you. They're going to give you a migraine. They're going to do some stupid shit. We've seen it. And that's everybody has to start off somewhere, but it's best for you to keep your business streamlined and have a kind of a basic thing. Like we used to start, it has to be around $25,000. And then we bumped up to 50, and then we really prefer $100K or more. Now, the investor questionnaire that I literally will then send, so how much are you looking? Okay, I think we can do something with that, is a nice little investor questionnaire. Now, especially when talking to them on the phone, I've already asked them, I probably asked, well, so what, they tell me what they're invested in or tell me what they're looking for. And I ask them, okay, what kind of projects have you done? Tell me a little bit about your past, your real estate stuff. And so they go, I've done fix and flips, or I've done wholesaling, or I've done this, or I've done that, or I work too much, I don't have time, but I've got this money sitting on the sidelines for an old 401k that I need to roll into something. That's the time. I say, okay, great. Let me send out an investor questionnaire to you. And it's a 1-page questionnaire, simple questions. Like the first chunk of it is, hey, what's, their information, names, emails, where do you work at, how many years you've been doing that, okay? Then I dive into, let me just bring mine up here real fast. I'm not going to share this. It's not something I'm going to send out. At their information, existing job, career, number of years, and then the what have you invested in before? A couple lines for that. Then I ask what their adjusted gross income is for the last 2 years. We're getting close to 2017 being over, so it'll be 2016, 2017. And I'm not asking for tax returns or W-2s or anything like that. I'm just asking them to tell me what their adjusted gross income is. It's important because you want to fill it out. It helps also to determine if they're a accredited investor or not. All right. Now, if they're not an accredited investor, that doesn't mean you can't do individual deals with them. It's just that you got to be a little bit more careful with them. Okay. Have you invested in real estate prior to this? Yes or no? And yes, what types of real estate investments? Okay. Then I ask, where is the investment coming from? A credit card, an IRA, cash, 401k, CDs, or equity line. Now, there's a couple things on this that will be a big red flag. If they say they circle credit card, that's a red flag. Like, listen, I appreciate it. but you got to realize my joint venture deals are going to be 12 to 18 months. They're not going to be 6 months. Yes, you've got a teaser rate of 0% for 6 months, but what's your payment going to be after 6 months? And can you afford to make those payments in case this deal drags on to 12 months? Okay. The other thing on here that is important is if they say cash, I want to make sure it's not a big suitcase full of ones or 20s, $100 bills. All right. If they say equity line, I want to make sure same thing as like with a credit card. Hey, are you going to be able to make the payments? Is this going to hurt you if it drags on for 6 to 12 months, especially if it's a non-performing note? All right. Question. We had a question, Nicole?
Yeah, Tanya asked, I think you already answered this question, but she's, do you need to worry about their source of funds? Should we be concerned about their funding a deal on a credit card?
Yeah, I think we just answered that.
You just answered it, yeah.
Perfect. Yeah. If they're funding on a credit card, not a good, because, and I don't say this with voice of experience. I had a lady that funded a deal, and 6 months go by. It was right on the front. It was a Florida deal. We knew it was going to take 12 to 18 months to foreclose. Lo and behold, after 6 months, she started getting antsy. I'm like, well, why are you getting antsy? She says, well, the money I got was from a credit card. I'm like, ugh. And the interest rate is now like 19.9% on it. I can't afford it, and I'm losing my house. And I'm like, well, it's not my fault you made a stupid decision to have your money go that way, but let me see what I can do. You know, I ended up having to refinance her out, and that was a pain in the ass, and go from there. So, but anyway, let's move on here. So, after where is the money coming from? If you are to invest, would you be comfortable tying the investment up for 12 months? Yes or no? If they say no, I'm probably not going to work with them on a JV deal, because most of our deals will take over 6 months. It's not going to be a 90-day thing. And I get people asking, well, why if somebody that wants to get their money flipped in 90 days to 6 months? I'm like, well, how often are they doing that right now? Because if they're not doing it right now, it doesn't hurt to tie their money up for 12 months if they're going to make a better return on their money versus them trying to do one deal in 90 days and then it sits vacant for 9 months. Okay? Question.
Actually, another one from Tanya. What about foreign funds?
Foreign funds, we'll cover that in a minute. Okay? Let me get through the rest of the questionnaire here. If you are to invest, would you be comfortable tying the investment for 12 months? Yes or no? Are you investing money out of a self-directed IRA? Yes or no? If yes, who is your custodian? This is important. You want to find out who the custodian is. With a self-directed IRA company like Quest IRA, great. If it's with a company like Equity Trust, no. And I only say this because Equity Trust is like the slowest in the industry. They are not the easiest to deal with. They're the largest custodian, but honestly, I will not fund deals that go from an Equity Trust account most of the time. It can take up to 2 weeks to get them to fund something in a timely fashion, and 2 weeks is not timely. It's also important to realize where their money's at. If it's like this is Schwab or Chase or Scottrade, that adds time to your schedule, because for somebody to move money from like a Scottrade account over to a Quest account, it's going to take at least 3 business days for Scottrade to move the money from funds into cash and then either send a wire or, God forbid, they have to send a check. All right. So you want to make sure, if yes, who's your custodian, to find that out. If they say it's not like Quest or somebody that you know, you need to bring that to their attention. Hey, you need to go ahead and start the process of moving this over. Okay. And then I get into kind of, for interest payments, however many like payments, quarterly, semi-annually, annually, or one lump sum of my investment. I don't offer up monthly payments. It just is too big of a pain in the ass paperwork-wise. Do it quarterly. It also saves them money on funds and wires or us on wire fees. And then I asked the questions. What would you say your net worth is, including real estate? What would you say your net worth is without real estate? It's important to ask those questions. Are you currently involved in a bankruptcy or a lawsuit of any kind? Yes or no? If yes, please explain. This is a filter. If somebody says they're in a lawsuit, they're suing people for things, probably don't want to do business with them. Okay? Oh, I'm suing this speaker, or I'm suing this person for their coaching, trying to get my money back on that. That's usually not somebody you want to do business with. Okay? If somebody's been through a bankruptcy before, that's not a negative thing. You just got to be careful of how they're using their money and make sure it's all kosher. And then the last question I always ask is, what type of real estate education classes have you purchased or attended in the past? And I want a full list. Oh, I've gone to Eddie Speeds. I've gone to Scott Carson. I've gone to Ron Rand. I've gone to Bill Gatton, Rich Dad Train, or whatever it is, Fortune Builders. I want them to fill that out so I know what their experience is. Because the more seasoned, the more experienced they are as education, usually less questions they'll ask in the long run. Plus, the more knowledgeable they are when it comes to things. Because this is more of a CYA, cover your ass questionnaire. Okay. Now, Tanya asked, what about foreign funds? Well, I always say you need to have that investor speak to their attorney about getting funds in. Because it can take a little bit of while to get funds into the States, depending on where it's coming from, whether it's either internationally overseas and they've got some restrictions with that. That's when you need to say, hey, you need to speak to your banker or accountant or talk to this person, or I refer them to somebody that very knowledgeable that works with different companies. If they need to set up an entity in the States, to do that, to make it legal, to make it easier with the Patriot Acts and things like that. That's when I refer them over to Laughlin Associates and let the staff over Laughlin kind of help that out. And then once that money, I said, well, let me know once the money's stateside, and then we'll talk about it. What I don't do is I don't deal with international investors as a fast funding party, because it's not. And oftentimes I see investors do that. Oh, I'm dealing with international money and it's it takes forever to get done. It can take forever. Now, that's not saying it doesn't work. Our buddy Garrison works with a lot of international investors, but he's already got that system set up. So when he needs to fund something, a wire comes in relatively quickly, or it's already sitting here in escrow, waiting for it to take things to the next level or him to purchase the asset. Okay? So I require every spot of this to be filled out. If an investor does not fill this out in total, I send it back to them. If they give me crap about answering some of the questions, well, I don't want to disclose that to you, and then I tell them that I'm not going to do business with you. All right, I want to make sure who I'm dealing with here. I want to make sure they're good. And one thing, too, everybody, do not get caught up in this scam that is happening when you see hard money lenders say they're going to give personal loans all day long. All right, we're going to do a personal loan. We'll give it to you like 5% interest. I just need a $5,000 fee in the front end. I've had friends get scammed because they thought it was so good. $250,000, guy's going to fund me on deals on a 5% interest rate, and I just got to pay $2,500 as a fee. If you've never met the person in person or talked to him on the phone, it doesn't work well. And I'm asked my buddies, like, well, how'd you meet this person? Oh, it was all through via email. I'm like, well, that's a scam.
It's like the Nigerian prince.
Kind of like the Nigerian prince, exactly. Reminds me of the American Hustle movie, where they were, doing commercial loans and taking $5,000 to $10,000 in fees on the front end and not delivering anything. Okay, so don't get caught up into that. This is why you're still going to raise most of your private money from around people that are around you. All right, in your local area, and this is why it's important to have that. Now, one other thing that I ask people to send when they send the investor questionnaire back is I also ask them to send a pledge letter. Now, pledge letter is very simple, not anything difficult. It's basically an email that says, hey, Scott, enjoyed visiting with you, attaches our investor questionnaire, filled out along with a proof of funds from our IRA account or my Schwab account, whatever it is. And we'd like to allocate, we talked about putting 50 to 100 grand to work with you. That's all this pledge letter is. Doesn't have to be on fancy. This is an email over to me. Hey, this is good. This proof of funds is good for 6 months or something like that. Okay. Question.
Yes. Tirso?
Tirso?
Yeah. He asked, what if the person does not qualify as an accredited investor? Can we still work with them? Is there any precautions we need to take?
It's a good question. What if they're not an accredited investor? Can you still work with them? Yes, but this is why you want them to fill this out. Okay? Still want to talk to them about what's going on. What are they doing? There's a lot of people that aren't an accredited investor because they don't make the money they need to make an annual year, but they still do a lot of deals. Those are the kind of people you still do one-off partnerships with those people. All right? Still talk to them about what's going on. Share with them the information. Have them double check your information. Okay. But like I said, Teresa, this is why you want them to fill this out. You want to make sure it's not their last 50 grand or 25 grand. And if somebody comes to me and says, hey, I want to put 200 grand to work with you. Okay. I always take that number in half initially. Okay. Well, you said 100. Let's start off with 50 and make sure that we get along together. All right. Let's start off with 50 and we'll go from there. That's always a good thing. It's their first deal. They come in, I got $1 million. Well, let's start off with 100 grand and figure out, let's make sure this works for you. Okay. Questions from anybody? Good. So the thing is, trust your gut. If somebody's an ass, if somebody's just rude, don't do business with them because they're going to end up being rude to you. And even though how desperate you may be initially to raise capital because you've never done it before, just take a deep breath and relax. It's okay. All right. And if a deal that you had an investor interested in falls through, whether the due diligence turns out bad or somebody else bought it faster than you did, just share that. Hey, listen, somebody else closed on this a little bit faster than we did, or they offered more than I wanted to go to. Share that information. Okay. Or the deal didn't turn out as good as I thought it was going to be, so I scrapped it because I didn't want to put your money at risk. Share that. People love to hear that when you mean it, because it's it's the truth that you're watching out for this person's best interest if possible. Okay. Questions? I mean, we're excited. We had Jillian Sadati coming on Note Camp to talk about the business. We have John here, the IRA investor, coming on, who's fought the IRA twice and won twice. That's going to be a good session.
He fought the law. And he won.
Yeah, I fought the law and I won. John fought the law and John won. We might need to come up with an infographic for that. Look, raising capital and talking with your investment partners is all about just talking and asking questions and listening. Now, if you want a good chore in listening or talking with investors, go to your local bank and ask to speak to their financial advisor. Okay? Or go to a Schwab or a Ameriprise or American Express Financial or something like that and sit down and start talking to them. They will pull out a profile sheet and start asking you questions. How do I know this? Because that's what we used to do at Chase Bank. That's what we used to do at Smith Barney. Okay? Citibank. Those are the things that we used to do, is going through and answering those questions. It's a good chore. It's a good must-have to do. Okay? It's got to be something that you do on a regular basis. It's not that hard at all. Hey, great. I talk to you. I'm going to send you over an investor questionnaire. Please take the time to fill it out and get back to me. But I need to fill it out 100% complete. Now, I've had some people that didn't want to fill it out completely because they didn't want to send it back to me filled out. They wanted to get on the phone and have me fill in the rest of the information, which is okay. I don't ask for their last four of their social security number, their mother's maiden name, their date of birth, their favorite pet or their high school mascot. I don't ask those things. All right. But what's on here is important. And then that goes into their file folder. We have a JV file folder, whether it's electronic or it's actually a hard file folder you can keep, where you keep the deals in there. You keep it in there. And when you have deals, eventually what's going to happen is that you get deals in. Those are the people you reach out to. Hey, I got a deal now. Hey, I got a deal. You got some funds available. Hey, I got some funds available. Because if you don't put people's money to work, oftentimes they'll, especially if they're savvy enough, they'll start putting it to work in other places. Now, a big thing to keep in mind, huge thing, if somebody tells you they're going to invest with you, all right, and you're working through a JV agreement, or they fill this out, and you're sharing with them a deal, and then they pull the rug out from you the day of funding because they decide to go somewhere else or they get cold feet, don't ever do business with them again. I've had several cases where we did everything right on our end. We got a deal. We're going back and forth on a few points in the JV agreement, and you get around to funding day. I'm like, okay, you're ready to fund this Friday. He goes, somebody goes, well, I found a deal I could not refuse. I'm like, really? You refused me even though we've been working with you for a couple of weeks. We've been talking, and you're going to go somewhere else because you knew we were going to close a deal, but now you pulled your funds. I will never do business with somebody who pulls funds like that. If they get cold feet. Now, the thing to keep in mind is you get yeses along the way. Now, if you don't make them fill this out, you don't have to send them a pledge letter, they're just going to get cold feet pretty much anyway. This is why it's important to get those virtual yeses along the way. Yes, you get a yes with them when they want to get more information. You get another yes when you get on the phone with them. You get another yes when you send this to them and they send it back. You get another yes when they send in a pledge letter. Those are all like 4 or 5 yeses. And then it all comes down to funding. If they need to open a self-directed IRA account, they open an account request. That's another yes. All right. But if somebody says, and they get cold feet or they overanalyze, deal and run, just don't waste your time with them anymore. Just don't waste your time. And look, there are some things that will pop up that are, we had a hurricane okay? Or we have a medical emergency. Those things, I respect that. Not a problem at all. But what I do not like and will not put up with is somebody who out of the blue just pulls their money for something else. When they know we've been working through things and they're not, and if they should, hey, I got 2 deals. I'm working on 2 deals, either your deal, this other person's deal, whichever can fund fast. I will respect that, but not to go blind on me, go dark on me, never respond. I've had people do that. They will never get another deal, and I will alert everybody I know that they will do that, okay? Another thing to keep in mind, sometimes people will overthink assets and go through everything. So, if you've done your due diligence, which you should all be doing on a deal, stick to it. Feel free to share that information. Oh, well, this is the reason why. Oh, okay, that makes sense. And that's okay if your investors have questions about your deals. I had a conversation with one of our funding partners. Well, have you seen the crime map around this asset? And I had forgotten to pull it on an asset. And even though it was a great asset where the borrower is going to make payments, they're begging us to do a loan mod. Jen knows the deal I'm talking about in New York. Mm. I'm like, you know what? You're right. I don't want to put your money into that one. Let's put you in a different one. I'll go ahead and fund that deal separately, have my money involved on it. Okay. But, treat your partner's money like it's your money, or better than it's like your money, like it's your mother's money. Hopefully you all love your mother. Okay. Question, Nicole?
Yes. Brady Durr, he says, do your investors have input on exit strategy, or are they just along for the ride?
It depends. Yes and no. Now, we have an idea of where the asset's going to go on exit strategy. It's going to get reperforming, and then after 12 months, we could sell it off. Now, that's what the JV agreement is all about. It's just discussing that with your funding partners on what happens next. If it becomes a reperforming note, do we want to keep it and hold it for cash flow, or do we want to sell it off? If it's, now the biggest thing is I'm still controlling that. I'm not going to let them dictate where it's going on the front end. Like if it's going to be a reperformer, it's going to go reperforming. I'm not going to say, well, no, we're not going to accept that. We're going to foreclose. That's not necessarily the case. I want to make good sense along the way of the assets, okay? But when it comes to it, if they want to buy me out after 12 months and keep the asset, they can. If I want to buy them out, it's discussed in the JV agreement. It's just a conversation. Now, one big thing we also do is if it starts running beyond 12 months, and assets will do that, is offer up the opportunity for somebody to listen after 12 months. If you want to get your money back, we'll give your money back to you plus a 12% return, because I'll go out and find somebody to get them refinanced. Now, another thing to keep in mind too, if it's before 12 months, say 6 months, you can bet your ass I'm not going to give that investor any money back as far as interest, okay? They're going to get a penalty also, because if they had a CD or an annuity with another firm and they decided to break that, there's a penalty involved. And I charge a 25% penalty, because now I got to do something that's different in my time frame. And now I got to go find a new investor, and I got to take that new investor's money away from a new deal and put in this old one. Okay. So that's the thing to keep in mind. If someone wants to get out of the deal before 12 months, it better be something good. If it's just, I want to move on to something else, well, you signed an agreement with me here. You agree to this. There's a penalty for you to do that. And if they get upset about it, I'm like, listen, you signed on it. It's business. We're in business here. Okay. I don't run a charity. We're in business here. You've got to do, if you expect me to do the things I sign up to, I'm going to hold you to what I expect you to do. Okay. That doesn't mean you can't have somebody involved who's getting more knowledgeable notes and wants to see servicing issues or see the collateral. That's completely fine. That's completely fair. Okay. Totally great. I will even share what's going on a regular basis. Hey, we got the sellers dragging on getting the collateral. It's at 45 days now. We're reaching out to them. I'll copy them on emails. Okay. They see what's going on with the attorneys. They see what's going on with the servicing, the taxes. Okay. We share that information so they see what's going on. If somebody's dragging on, I communicate, hey, this is dragging on longer than expected, to help solve those issues. Okay. Questions from anybody?
Yeah. Laura Blanc just asked, do you include that penalty clause in your partner's contract?
Yes, I do. It's good to do. Now, especially first-time investors, yeah, we'll do that a lot with. Now, it's different. I would say I don't always. If I've done business with a lot of them before, I won't include that in there. But if somebody's brand new, they've never funded a deal before, you bet your butt I include that in there, because it's just a good business. And I'll say, listen, You know, you may want to have an initial that next to the JV agreement. This is, you got aware of this. The reason I'm putting this in there, because if I'm going to do the work and you're involved in this deal, if it gets beyond 12 months, then we have the right to get out. Okay. Beforehand, if you do, I'm just going to penalize you 25%. You're not going to get any interest. So yes, if you invest 100 grand with me, I will only get you back 75 if you do it before 12 months. All right. There's a cost of violating contracts. Now, same thing. If, what was I going to say? If somebody's within that 90-day period, you know, it's 10 months, we're getting close to 12, and they ask for a refund back, that's fine. Great. You got to give me 90 days to get your refund back. That's an important thing to keep in your JV. We talk about that. Listen, you need to get refinanced out. It's going to take 90 days. You got to give me 90 days to do that. Now, it doesn't usually take 90 days. Sometimes it drags on a little bit, but I communicate. In some cases, we've had it where like, okay, what do you need that money for? Is it for a different deal? Is it for something else? And I'll do a partial refund. Oh, let me split this refund up in payments as we close on other deals to get stuff done. And as long as you have a solution for your investors, they're going to be happy. Question?
Yes. George Crocker asks, is it best to go with a 50-50 on a JVL versus a percentage?
Good question, George. And that's up to you. You have to look at the deal. All right. Now, equity split versus a flat return, you have to ask what are they looking for. That all comes down to what the person's looking for. All right, and what the deal will hold. Now, if this would be a reperforming note that's yielding a 25% or 40% return, you may want to go 50-50 so that they're seeing a 20% return on the cash flow and you're getting the other half. Or you may want to go just a flat 10, 12% interest rate. Some people are different with their model. If they're coming from a CD or annuity where they're getting a flat interest rate may be something that they enjoy more. I deal with a lot of real estate investors who don't want a flat return, obviously. Okay? So they're looking for more of the equity split being 50-50. But if you can find cheap money at 6, 10, 12%, that's all they want, and they're happy with that, by all means, give it to them. So that's a question that only you can answer for the conversations you're having with your potential funding partners. Another question, Nicole?
Yes. Tanya asks, what do you do if they can't, what do you do if they don't come up with the additional funds or capital? Do you dilute?
I don't understand the question. If they don't come up with the extra funds, I don't.
I guess if they're waiting on other money or something, I don't know.
I don't know Can you rephrase that question a little bit, Tanya, for us? Okay. I will tell you this. We usually try to have our funding partners fund extra. If the deal we're funding for 25 is what the purchase price is, we try to get them fund 30. That gives us a little extra cushion for expenses and other things along the way. And if we close out the deal faster and we refund them back to 30, and I didn't use that $5,000 difference, guess what? It's now profit. Okay, something goes into our slush fund for other things. Okay, because there are going to be other operating costs or other expenses along the way. Okay.
She says in the profit.
I still don't understand the question. So Tanya, can you rephrase your question? Start to finish versus diving it up, because I love it. I love that Tanya's asking questions. Tanya is so hungry and kicking butt and taking names and doing some great stuff. So I'm not finding any fault in the question. I just don't understand it. So just ask the question clearly from the beginning to start as well. One of the great things is the more often you have these questions and questionnaires, and the more you're talking to people, the more selective you can be in your funding. What do I mean by that? You can pick people that you just want to work with. You don't have to be desperate just to try to get a deal done. Okay? You just have to, you got to have these questions. You got to have these money questions. And that's difficult. If they were to go get a bank account or go get an annuity or invest with a 401k or something like this, they're going to ask these questions to figure out their risk. Okay?
Yeah, okay, so she re-asked. She says, if you need additional funds and the investor can't come up with them, do you reduce their percentage in the profit?
Oh, okay. So like we have them fund like say 50 grand in a deal, and then we need like 5 grand or 10 grand later on for expenses. Do I reduce their principal or no? I don't do that. So what we do is it's set up basically this way. If you're going to do an equity split, this is one of the things that you want to do. All right. There's going to be expenses that happen during or while you're working through the deal. If somebody's going to fund 50 and you find out the property needs to be rehabbed. Okay? So you got to put 10 grand into it for the rehab, but your funding partner doesn't have that money in their IRA, and you've got to fund that. So great, you fund it. Treat it as an expense. So when you sell that asset off, you pay back the 50 grand, goes back first to your investor. They get their investment back first. Then you cover any expenses second. So if you pay 10 grand out of your own pocket, great, you pay the 10 grand. You might even want to charge yourself some interest on that 10 grand. So if it's a short-term mezzanine loan, 10 grand for 6 months, and you got to pay 12% interest on that, guess what? You're adding $600 to that as an expense. That's getting paid second. And then the profits will be split 50-50. Now, that's the thing you keep in mind. They're funding most of the project, okay, 50 grand in the front end before we get to that. I'm not going to sit here nickel dime. I'll still split the expenses up 50-50 on the back end. That's just good business. All right? That's just good business. You know, the investment gets paid back first, any expenses come second. And cost of money, if you're taking out a hard money loan or a private loan on that money, the clock is ticking and they got to be paid back. Okay? Good stuff. Good stuff. Lollipop. Look, it's all about just having the conversation. It's all about talking with people, getting to know them, getting to see what they're doing. It's kind of reminds me of that song, Getting to Know You, getting to know all about you. All right. Yes, I won't sing. I'll stay to the podcast on notes, not on the notes of my voice. But what I'm getting at, everybody, look, it's also good to talk to other people. Hey, who else have you done deals with? Oh, I done Wayne deal, or I funded Gail. Great. I will call Wayne and Gail and ask, how's this person? Were they a pain in the ass? And I will tell them, okay, great, they want to do some deals with us. Are they a pain in the ass to deal with? No, they're good to deal with. Awesome. I asked for references. If somebody's never done a JV deal, okay, great, that's fine. But if you have done a deal with, who have you worked with? How's that working out for you? You know, I ask, when they ask what they've invested in before, what kind of returns are they getting with that? If their money's sitting in a CD account, they're probably making 1% of their money, if that. So it's important to keep that in mind. Then you may be able to, like as George said, you may be able to have that conversation with them. Well, I see you're only making 1% on your investments. What if I could show you 6%? Would that be something you're excited about? Well, yeah. And you're going to have those conversations with people that are less savvy in real estate or haven't done much. They'll be cheaper money for the most part. But there's going to need to be more hand-holding as you answer more questions with them. Okay? We're good? Good. Awesome. So this is a conversation. We could spend all day talking about this, but literally the important thing to keep in mind is create your own investor profile questionnaire, create your sample deals. All right? The different workshops we've done, we've given sample deals, investor questionnaires. And I'm always amazed somebody sends those sample forms out and leaves my logo and my information on them. Every class. And so what happens? I get a phone call from somebody. Hey, I came across your sample deals. I came across your investor profile. Okay, who sent you? I'm not going to tell you because I don't want to fund with them. I want to fund with you. I'm like, awesome, thank you. Somebody just did all the work for me. I wish I could send them a steak dinner. But anyway, you get what I'm talking about. So go out as you're networking people, talk with people. Don't be like a brand new puppy. You gonna find my deal? You gonna find my deal? Take it simple, relax, breathe, and make it a multi-step approach. Hey, where are you from? Okay? Form them, talk with them, meet them for coffee, get on the phone with them, email out the investor questionnaire, ask them for the pledge letter, have a deal for them to put their money into. Okay? It's not hard to do. It's easy to do to make things happen, everybody. Okay? All right. Well, that's all that I have for this episode. Hopefully this has been helpful for you. A lot of questions from people. If you like this and you're watching this live on Facebook Live, feel free to share this. If you are listening to this on iTunes, Stitcher, or any of the other podcast forms that we're on, make sure to leave a review. We love reviews. We'd love to hear how we're doing. If you've enjoyed the show, hey, share it. If you're listening to it. Once again, if you're listening to the podcast at work, at the office, we'd love a selfie of you listening to us. What do you listen on the phone? We like to know what you like, what you dislike, and what we can do better to make the show a better experience for everybody involved. So hopefully go have a great day, everybody. Go make some stuff happen. And we look forward to seeing you all at the top, everybody. Bye.